podcast where we put you on the map. This is Ron Costa broadcasting live in the Mappable USA studios here in Las Vegas. And today, folks, we're going to switch the topic around a little bit towards opportunity zones, opportunity zone funds, and things to look out for, et cetera. A couple of really good points, and maybe we'll break some news as well. So before we do that, let's bring in Vicki Hutchmala from the QOZ Marketplace and the Opportunity Zones Authority. Vicki, how you doing today?
I'm outstanding today, Ron. The sun just came out. It's beautiful. It's Friday. And we have a special guest with us today. I'm looking forward to this podcast. It's going to be very exciting.
Yeah, I agree. It's always nice to do a podcast after a rainy and snowy Thanksgiving in Las Vegas. I know that sounds a little crazy, but folks, that's what we were involved with yesterday. But it was a good day nonetheless. So anyway, let's move forward, Vicki, and introduce our guest. Folks, we've got Aidan Doyle out there. He's the CEO of the Cinderella Target Value Zones Fund. And Aidan, how are you today?
I'm just fine, Ron, and happy holidays to you. I know it's the Friday after Thanksgiving.
Yes, we're the only ones in the world working. I guess that's a good thing. But yeah, I'm really glad that you took some time to be on our show today. I know you have so much going on, and what you guys are doing are really, really fantastic. Well, so let's just start the show off by maybe telling our audience a little bit about yourself, your background, and how you got into this whole Opportunity Zones thing in the first place.
Terrific. Okay, so for the purposes of this podcast, my relevant roles are I'm the CEO of Cinderella Target Value Zones, Inc., which has the distinction of being America's first and only publicly traded Opportunity Zone Fund. Its creation was a little technical. Basically, we bought a shell publicly traded company, and we basically refurbished it and rebuilt it and converted it to become an OZ fund. I am also, and additionally and more relevantly, the president and CEO of Bellwether Capital Management, who are a Wall Street-based registered investment advisor. So from both perspectives, we're in the fund management and financial services business.
Okay, well, you have to have seen something special in Opportunity Zones to want to go and actually create a shell company into that. That's pretty impressive. So what is it about the Opportunity Zones that really kind of sparked your interest and said, yeah, you know what, let's go for it? It was just maybe being the first of your kind?
Yeah, well, there's a story behind that, which I don't tell too often, but simply put, over the years that I've been in financial service, be it stockbroking, hedge funds, etc., I've always had an affinity to head towards or to pay some attention to impact investing. You know, always one of those bucket list, wish list things that you wanted to do, but I never managed to get myself in a situation where I could, zero in and apply myself to it. And then lo and behold, legislation comes along in 2017 that's precisely what I'm interested in and works precisely with my skill set. And more incidentally and fortunately, at the time, we were looking to pick up a publicly traded entity. We hadn't really purposed it entirely, so we tinkered with it. We looked at the possibilities. We reconciled the misconcepts and the misfits between liquidity and long-term investment, but we think we've got it right. And the short answer is, now that I look back over the last 2 years or year and a half that it's taken to get this company in this position that it's in, we're extremely pleased, and we think we're in the right marketplace at the right time.
You think Opportunity Zone as the program is going to go further into the future than it is now and be a little bit clearer in its rules and regulations for more people to participate?
Yes, well, it has to. And if you look at the history, as such of the legislation and the few reforms we've seen or the few revisions to the codes and the statutes. This bill was passed in 2017, as an aside, as an addendum, as an AKA also ran. It wasn't prepared with years of foresight, so naturally it needs to be fleshed out, and that's what we're seeing. However, at its core and its principle is exactly what lots of people have been looking for, and it's an idea whose time has come. I don't wish to be too much of an evangelist, but I see the writing on the wall, and I do read a lot of these white papers and listen to great podcasts such as yourself and watch YouTube videos and watch the PowerPoints. And, this is a burgeoning market, and the only thing it needs is someone to lean on it and a little more clarity in terms of the rules and regs. And then Main Street, Wall Street will definitely be aboard, and then we'll see a completely different marketplace as we're seeing, and for want of a better acronym, a completely different asset class.
Oh yeah, this is and Ron and I completely agree with you. This is why we do these podcasts on Opportunity Zones, so that we can let our listeners know more about them and know what it is and what's involved, because through our travels over the past year and a half or so, it's amazing how this is an outstanding opportunity for an investor as well as the community invested in, but a lot of people don't have any clue what it is or how to go about it or anything about it. But we believe it's an excellent program for the future. And
exactly.
The time is exactly right, just exactly what you said.
And I'll say something else. This has nothing to do with financials or bipartisan legislation. I mean, culturally, we think more about what we do. We eat differently. We behave differently to our neighbors. We're politically more sensitive. And we tend to be more thoughtful in just about all our activities and, our occupations and how we consume things, including our investments. So anything that has a redemptive feel-good nature, such as the Opportunity Zone legislation, it's kind of drawing more people than it would have done 10 years ago. This is why I mentioned, yeah.
Exactly correct, because investing in opportunity zones gives the investor a return, which is what they're looking for, but it also gives them that feel good, I've changed the world, I've done something great, and I've lifted the lives of people in the community that I invested in, and so it's a win-win. And when everybody is winning, what could be better than that? Getting that absolute pat on your heart.
Exactly. Well, this is what there's always been the opportunity to impact invest, but it's not on the national scale, and not to the degree that we've seen here. There were some funds that got involved in some bonds and some minor funds of this nature, but they were few and far between. But this is an all-impacting national program, and I look at my inbox every day, and exponentially, if I put it on a chart, you'd be surprised at the amount of interest I'm getting from all quarters, both projects obviously looking for funding, but on the other side of the balance sheet, I'm getting a lot of inquiries from would-be investors, and that's going to escalate as we come towards the end of 2019 tax year. So
absolutely.
See momentum ahead.
There's more clarity now in the rules and regulations and how the criteria for how to set it up, how to go forward, and make it a little bit easier to get involved and take some of that complexity out of the program, which will make it easier for everyone. So
exactly.
tell us about your fund, and do you have any projects, or what area of the country do you invest in?
We're on the Eastern Seaboard now, mostly because from a practical point of view, it's easier in terms of management. We can do it ourselves. I will say, for the record, our first project, our cherry per se, is actually in Manhattan. Okay, I had this conversation. Okay. Yeah, I had this conversation naturally with my peers and discussed, the hot spots as far as the national OZ map is concerned, and they look at me with disbelief when I tell them that our first project is actually in Chinatown, no less, Lower East Side of Manhattan, which is quote unquote an opportunity zone. So is the Upper West Side, Clinton, formerly known as Hell's Kitchen. A lot of the Bronx is classified. Areas in Brooklyn, you'd be surprised. So. And there are small wedges of OZs that are so small you think, why did they make them census tracts anyway? But the local governors and politicians deemed it appropriate, so that's what we look at. We don't discount any part of the world, but from a practical point of view of management, we've kind of started in our own backyard, and we intend to fan out.
Yeah, and it's important, too, that people understand that the specific opportunity zone is based on the census tract and is relatively a depressed area, but the properties that are adjacent to the opportunity zone are just as important in the project that you developed within the opportunity zone, and it becomes relatively symbiotic to the people who live there.
Exactly. So
yeah.
The more I think about this program, I kind of try to step back from the tax aspect of it. And I'm going to explain what I mean by that. So you've heard the expression, don't let the tail wag the dog, don't put the cart before the horse. You know,
right.
Look at the fundamentals of the project and forget the tax benefit sweetener. Would you invest in it if the tax wasn't here? So we take that a stage further in terms of our analysis, and we just we just discount the tax period. We consider the investment as if they were just post-tax dollars going in for X horizon on fundamentals and fundamentals alone. And whilst you hear constantly there's trillions of capital gains on the sidelines, let's not confine the market to just that. That is great, and it gives you some low-hanging fruit. But let's talk about people investing in it just on fundamentals alone.
Exactly.
My idea is this. Yeah, exactly. This is what the market should be. It shouldn't just be for one group that's in a particular category or bifurcated by circumstance. It should be for those that see the value and want to invest in it anyway. In other words, what am I going to say to a client that wants to be an impact investor, wants to be in the fund, but really doesn't have any gains to bring into the equation? Am I going to say, no, this is not for you? Not really. If I love the project pre-capital gains tax deferment and possibly emission, I'm going to love it anyway. So
exactly.
Here's the thing. The market is, what you don't want to do is just have a capital gains tax market. That's going to get a little sticky, and it's going to swing and it's going to vacillate with capital gains tax marginal rates and all kinds of administrative things. You want the market to be solid and you want it to be robust. And what's going to happen is people should invest in these. There should be momentum at some point because of the money that's going in there anyway. In other words, you heard the expression, rising tide lifts all boats. If I know that there are the $20, $40 million just went into downtown Detroit, I'd probably want to put a Starbucks in there. If I was running franchises for a lot of these big groups, I'd keep an eye on these OZ money because that tells me development is coming soon. That tells me infrastructure is changing, and that is the biggest indicator in the world. So we want to do what the regulators and the legislator had in mind, which is spur economic development. The tax side of things is great, and it's a nice incentive, and it's a sweetener, but it's like a stock warrant. A stock warrant is an inducement to buy the stock, but it's not why you buy the stock. If you can get one, great, but let's look at the underlying, let's look at the big picture first.
Yeah, I wish more people understood that point, because people should be listening to that, what you just said, over and over again, because it's really one of the biggest things that people have to realize about investing, just in general, where if the project doesn't pencil out on its own right, and you invest in a deal just because it's an opportunity zone fund, you know, if that fund goes down, you lose your money, you're better off paying your capital gains to begin with. So people don't get that. Yeah, it's really an important part of what you just said. Very, very key part.
It should be. These are weighted reasons, and the tax deferment / reduction in basis / forgiveness. All those things are great, and they help the conversation. If I'm speaking to someone with capital gains, but here's the thing: we don't just speak to people who have capital gains. We speak to people that want to be in. They want to be what a smart money is or is going to be, and we speak to people that want to listen to the fundamentals, regardless of post-exit considerations. They have attorneys. They don't need me. They need value, and they need the writing on the wall before the wall was even built. That's what we're trying to do.
Right, and then you talked about businesses as well. Does your fund take into account any kind of businesses that may work or relocate into an opportunity zone?
This is something I want to discuss very briefly. So naturally and typically, the wedge or the split between the existing managers, if you did any math or picked up any of the directories that are out there, has to be about 85% real estate and 15% the rest, okay? That's
right.
not what's supposed to happen, and it's not sustainable because, I hate the cliche, there's only so much real estate, okay? So what are you doing when you buy more real estate and develop it? Okay, in the regs they talk about must add substantial value, which means basically spend as much as you put in. But then what? So we have the converse view. We want to invert the market. We want 80% of the investment to be in private equity, in manufacturing, in fishery, in mining, in timbers, in projects that have no cap. There's only so much rent you can charge somebody per annum on so much space. So naturally you have a finite return, and that's the story. So we'll leave the real estate development to those that do that, but we want to take the other side of the market and develop it, and that's where we see the real economic growth.
Well, and you can be very creative with opportunity zones as well, because people tend to think of them as urban locations, but there's many opportunity zones in rural locations where they're dealing with agriculture. There's dealing with the new trend in cannabis farming and research and infrastructure, and that's equally important, as you say, and you can be very creative in where you go and what you do, but primarily, and the very bottom line is, yes, you have to do your homework, you have yes. to understand the location, you have to fit the right project in the right area, and know that after it's done, you've created an investment as well as a project that sustains the community. And all of that stuff you need to think of before you put a dollar down to invest.
And here's the thing, as well as what you've said, which I agree with, investing in businesses is very complex, okay? Compared to real estate, it's extremely complex. There's 1,000 moving parts. You're encroaching on areas that require regulation and oversight that most people either don't understand or won't be able to tolerate. And here's another thing to consider. The funds that are coming out of the gate right now, and I did a little research before our interview with Prequin, who are a research company, of every opportunity zone fund out there that's registered somewhere, exists, or on someone's radar, 70% of them are inexperienced. So what we're saying is 7 out of the 10 managers pretty much hasn't done it before. Exactly. Now we're expecting these managers to take on the role of quote-unquote fund managers. Real estate's one thing, and that's probably the skill set or the background they're coming from. But when you get into private equity, you're in a whole different universe. You've got to talk about compliance, SEC considerations, custody, administration, compliance with the current statute, AML, KYC, 1,000 things that, quite frankly, take some getting used to, and are not going to work for everybody. So the short answer is, I feel that the statutes will change and try to regulate a quasi-fund manager, not a full-blown but registered investment advisor such as ourselves, but some middle-of-the-road regs that speak to background, speak to a minimum amount of qualification that's financially related, and just impose a little bit of custody and safekeeping and quote-unquote supply the investor confidence that's going to be needed for these markets to flourish.
Absolutely, because if you don't know who's taking care of your project, your investment is on the line, and not only that, but you can become decertified by the IRS, and then the whole thing blows up because you didn't do the homework first to verify that the people behind the operation know what they're doing. Exactly. And just go to the IRS and say, okay, I'm going to become an opportunity zone fund and fill out a form, and now you're certified, but then you don't have a clue what you're doing. That's crazy.
That is what it is crazy, and we had this conversation offline, but to move forward, improvements are on the way. As we discussed pre-podcast, there are movements afoot to bolster the rules and regs and the suitability of the managers. and specifically to get some reporting, in place so that the program can see how successful they are at any one point, and B, the managers can have to account for what they're doing and how they've done it. Okay, so that's on its way. However, the way that it's on its way or being delivered is by virtue of extended information on the form 8996, which is simply a return made by the manager at the end of the year saying, here's what I spent, here's what the fund did, here's what it's worth approximately, and it's very static and historic information. It's a start, but it doesn't really help the market perform. So
absolutely, and that's one of the disadvantages, I guess, to the whole program is there's no history. This is brand new, and so until you can generate a history of what's going on and gather data as to successes and failures and why that happened, and then create rules that not guarantee but make it easier to go into the future with something more successful, that's what everybody wants, that's what everybody's looking for and waiting for. So that's very important, and that will change as more information becomes available.
Well, I don't know if you did that intentionally, but that was a perfect segue. As you remember,
Pretty good at this, Aidan.
Yeah, okay. So, looking at the market as I've done, and think about as I've done, and going through all the content that's out there, and the databases, and the myriad of opinions, both adverse and favourable. One thing's for sure, if it's a market, you have to get your arms around it. It can't be abstract and bifurcated and opaque. Someone has to be able to say the OZ market is in good shape. And right now, that's not possible. So myself and a few colleagues who will get credit when the time comes, we've developed, or we think we've got enough information and metrics to develop and launch an OZ index. Now, the first thing people say when I've mentioned this is, well, how are you going to do that? Where are the valuations? There's no data going back. It won't work. It will work, and the reason it will work is it's a self-fulfilling prophecy. So at the time of speaking, which is December 2019, depending on who you ask, there are about 150 to 200 funds out there. Again, it's a bit difficult to be precise, but that's a pretty universally agreed upon number. I'm pretty sure that you can give that a haircut of about 30 or 40% for funds that have been formed but to date haven't been funded and or deployed into projects. So then we're left with about 90 to 100 funds that have done something. Okay, if they've done something, the something they've done, their projects can even subjectively be given a value either by an independent valuer or on the ground locally, or by some way, shape, or form to give the fund manager a scorecard. So what we've done is, and what we are going to launch on December the 1st, is an OZ fund index, which is going to be divided into 4 categories. I believe real estate, private equity, manufacturing, agriculture, and I believe the rest is mining and fisheries. And whilst there won't be much information, it won't be too valuable at the inception, we believe that fund managers that are serious about their business and understand that they are asking investors to invest conceivably up to 10 years will understand that it's in their interest to be a part of the index, that it adds to their transparency, it encourages investor confidence, and more specifically from their perspective, adds to the marketability of the fund. Last but not least, the existence of an index will facilitate and possibly allow the manager himself to charge a performance fee to his investors because he's done better than, quote unquote, the benchmark, which in this case will be the actual index we're talking about. So from all perspectives, it's a good idea. So we think we've got a model that works. We've talked to quite a few people that have an interest and would, provisionally want to be a part of it. So we have a provisional date of January the 1st to roll it out.
Wow.
This is exactly. So full disclosure, this is a podcast as of late December. Because CTVZ is a publicly traded company, we are going to officially announce the launch of the fund probably next week in terms of a company press release, which I'll certainly forward to you guys. But in full disclosure, there's nothing I'm discussing here that's of an inside or classified nature. It's just a financial product, and there's no numbers involved. So you have actually been the first to hear it.
Well,
Wow,
we're very pleased for you, Aidan.
Yes.
That's exceptional. And Ron and I absolutely agree with you that because of the fact that there's so many people out there that really don't know what they're doing, it's a necessity to put together some kind of a list of an index to verify that this is an actual fund that actually has a success with people who know what they're doing, and go ahead and invest in it because you can feel safe and secure about it. So we're working on trying to do the same thing as well, and hopefully it will be a success for it.
Yes, well, the market, everyone wants to do things in a free and open manner, but unfortunately, you've got to convince people that you know what you're doing and their money's going to be safe with you, and there are interested parties and there are rules and regulations. It took me 20 years to get to this point. Regulators were the bane of my life. They used to reverse my trade.
Oh, gosh, yes.
Paperwork. But I hate to admit it, but I've evolved, and I realize that in terms of best practices, if you don't want your tax deferment and credits or benefits to reverse out in 2 years, you better do it right on the way in. And it's just that simple. I mean, if you half-heartedly or do things without good advice or without knowing the rules of the road, you will end up in a road crash. You will have a write-off on your hands, and I've seen those up close and personal, and lots of businesses can't afford that, and I can't, and I don't think my investors can either. So I appreciate the reason for the regs, and once again, it's to use your expression earlier, it is a win-win. If you play within the guidelines and you act as a fiduciary and you observe the letter of the law, and you're in a program that you believe in and you work hard for your clients, there's not many reasons that you shouldn't do well.
That's right.
Exactly. And anything that can inspire investor confidence in investing in opportunity zones or just investing in general is a good idea. So your idea with the index is great, but I'm wondering, could you just explain what you mean by the index in a very top-level term? Is an index the same thing that you see in the markets?
Yes. So here's how just to give it to use very basic. Just to use very basic description. For example, so far we've got 80% of the funds are in real estate. As I've told you, that's going to invert when the regs improve, when people get more confidence, and Wall Street really starts to swing a bat at it, and private equity understands that it can be done without too much exposure. So once that happens, what's going to happen is you have all these funds that were formed either by self-certification, or in my opinion, in a few months' time, they will need to provide much more. They will need to provide much more information, and becoming a fund will be much more stringent. But either way, they will exist. Those funds are deploying investor funds. Those funds are bringing in investor funds, and they're deploying them either at their discretion or into a definitive standalone project. Either way, they're representing the client, and they are technically should be a fiduciary, but I want to get into that. But the point is that they're acting for the client as a fund manager. So the client has every right to say, how's my money doing? Okay. Now, This is a 10-year program, so people think, oh, well, you know what, it's 10 years. Don't ask me now, call me in 10 years. But just because you can be in there 10 years doesn't mean you have to be. There are no lockups in this program. No one says you have to be in this for 10 years or else. It says, here are the benefits over a horizon of 10 years. So we looked at this and we said, this is great. And if we stay in for 7 years, we get the 15% increase in basis. But there's nothing to say you can't trade in and out of investors in the interim. Maybe the investor needs liquidity for all kinds of reasons. Life changes, and the horizon in real estate is about 5 times, 3 or 4 multiples of the horizon in private equity. So those asset classes will be bifurcated, and what would help it is the idea that there are performance metrics for all of them, and I mean all of them. So fast forward 6 months. Let's say we build the indexes and they work, and they're a realistic portrayal of how the funds are performing. What do you think is going to happen if the PE says 27% and real estate says 8?
Right. Yeah.
Exactly.
Yeah, definitely.
It's not going to be arbitrage. It will be, you know what it'll be? It will be OZ arbitrage. People will say, you know what? Real estate's great, but there's real money in PE, and you're doing it just as good. You have exactly the same benefits, only you're in a different market, and you definitely can change your horizons, etc. So, long story short, we'll leave. We as a company decided we're not a real estate developer. Incidentally, we will have to buy real estate. It just comes with the territory in some deals. But our true mission statement is to develop local businesses on the ground.
Right. You know, it's relatively easy to convince somebody to invest in whatever it is you're doing, but when they can see actual tangible information to back up what you're saying, it's a whole lot easier and you do a lot more investing.
Well, of course. I mean, you don't want to listen. The funny thing is, when I started as a stockbroker, I hate to hit you with a war story, but it's funny. We used to get on the phone and just call someone and say, you have to buy some shares in XYZ. It's the greatest thing since sliced bread, and they'd do it. But Those days are over. Those days are over. I mean, investors have a different temperament now. It's just how about this? They're more informed. They're can Google. They are more sophisticated, and they're not. There's the naive guy that sits in his rocking chair and plays golf once a week. Probably that's gone. The millennials are going to take care of him. So my point is, you have to adapt to the marketplace and the environment, and the marketplace, especially in OZ, if it's going to work, has to contain a modicum of transparency. All right, these funds have to be able to say, hey, I'm a fund, here's my numbers, okay? I'm a fund, here's my exit strategy. I'm a fund, here's my custodian. Here's where your money is. Right now that's very opaque. I have a wish list of things that I'd like to ask the regulators to insist upon in fund managers, and one of the things is a custodian, at least, or an administrator, a qualified registered custodian to handle the client funds. That's a no-brainer for me. But these things will come along, and as soon as they do, big money is going to enter the market. That's it.
Well, yeah, because big money likes to wait and see what other people are doing, get the kinks out, and then bring their money to the table because the kinks are out.
Yeah, not just that, but not just that, but it's not as if they have any choice. So the larger pools of capital around the world, they within their articles of association and their corporate charter, their hands are tied. They can't invest in certain issues, meaning stocks that have capitalized less than X, or have range worse than Y, or liquidity. They have criteria. So this is not to use a cliche, but it's been put in print before. This is still a bit of a wild west, So,
exactly correct.
Okay, which is not a bad thing, because it's like the gold rush of whenever it was, 1949 or whatever. People made money and some people got hurt. You just have to be selective and make smart choices. So
to be strategic and adaptable.
Yes, but here's the thing: in terms of momentum, I mean, we can all look at this market and say it's underdeveloped. This is, I don't believe that they haven't done this or something needs to be done about that. That's easy, okay? But the way to navigate through it and to believe in it, it will get you there as a business, and the momentum in itself and I've said this, makes me just discount the tax credit thing and say, someone said, how do we get some money into the zones? Let's get all the capital gains and give them a break. That's great, but that is just one sling in the bow or in the quiver or whatever it is. So there's plenty more. I would buy the zones because that $2 billion is coming in anyway. Do you understand?
That's right.
That's the way you have to think about it.
I think that using the capital gains deferment is the least thing you should be, that your priority should not be the capital gains aspect to it. That's just the icing on the cake that you get for all of the other stuff that you went through, and you should never look at it in terms of that. That's what we've learned in talking to several people doing our podcasts and just being informed about the whole program. Is the capital gains is a great thing, but that's not what should motivate you to invest in opportunity zones.
Well, you're right to think that. And perform this exercise. Ask yourself this. You know the marketplace is there. You have the ability to enter the marketplace. But you can't offer your clients, let's just say for some reason you can't offer your clients the tax breaks that the other funds can. There's some reason that you can't get any capital gains money. Would you still be in the market?
Sure.
Then enough said. That's the $64,000 question. Okay, you've got to discount that and put a pin in it, and then you can see if you're getting sidetracked or distracted by the sizzle, and if you're missing the steak.
Right.
Okay.
And it doesn't have to be strictly capital gains assets that you're investing. I mean, you can stack your capital and bring in different monies from different areas and make your project better. Another thing is, you can leverage the situation if you know how to do it, which we are very keen to. You can leverage and add to, and increase your basis, accordingly, which a lot of people don't understand. But when in terms of financial acumen, we're looking at that. Also, last but not least, I'm going to throw you my wish list out. I've already talked about I think that it should be mandatory that fund managers have an administrator or a custodian. All right, they're handling. I don't know where this money goes that's sent to their fund. I know the fund has to be an LLC or an entity, and I know they have to have equity. But after that, there's nothing that's really sets down, procedures and policies. An administrator. Secondly, I'd say an accounting provision, but that's just me. And also, we'll see. I don't want to be unfair because it is a burgeoning market, but I think an index would be a wonderful idea because you can compare investments in real estate in the OZ fund with investments elsewhere, and it gives you criteria. It's actionable information. We're going to roll it out on January the 1st. Exactly.
Excellent. Yeah. Hey, and Aidan, before we close out this podcast, I do have one last question for you. If I understand this index correctly, it could basically be a number plotted over time on a graph. Is that right? And then
yes, it will be. Well, as it comes to term, or as it starts to mature and has some some maturity, you'll see performance in a particular OZ asset class. You'll see what real estate investments did in the OZ market nationally, and we can get granular and talk about states and really do a deep dive and get in the cities. Once we have the data, people will want to do this. It will be self-fulfilling.
Where I was going with that was, if that graph trends upward, then that's tangible proof that the Opportunity Zones program in general is working. Wouldn't that be a logical conclusion?
Exactly. So I'll end as we're getting ready to wrap up. There's been a lot of outcry for metrics, social impact. How do we know we're hitting the target? Where's the proof that we're doing good? I hate to say this, but money is a great indicator. It's pretty definitive, okay? So and money comes to money, okay? money trickles down better than anything I know. I don't know about you guys. So if you can look at performance, and not only can you look at performance within an index or a sub-index or a geographical location or across even different types of investment, across real estate, private equity, you can use that information nationally or in terms of your portfolio if you manage a lot of money as a client and make investment decisions. I don't want to be in real estate in New York. Look what private equity is doing in Detroit right now. Get me some of that. Move my money, and that is moving from OZ to OZ, which is like a 1030. That's a 1031. Okay, so you've made a market that's flexible, has liquidity, and has the ability to, God forbid, to even hedge a position or to provide an extent of liquidity within the market. So now you're cooking with gas.
Well, exactly, because just because you live in one location doesn't mean that's where you have to invest. You have the entire country to invest in, an opportunity zone, but without the information, without the analyticals to know if that's a good place to invest, then that's not where you shouldn't invest just because you live someplace. You invest where the project's going to work and the fund is going to be successful.
That's what should happen in the real world. But I'll end by saying this. So one of the things we have in our brochure is we're a multi-project fund, a mixed fund, and we're a blind pool. Now that one, in English, that means we invest all over the place, and we don't really, we didn't make decisions on what to invest in. But we do have a subcaption in there that says, however, where the investor has a preference to a geographical location and or business, we'll try to accommodate him. What that means is, if a guy in Detroit has a ton of capital gains, and he wants to invest in an OZ fund, we'll try and get him. He probably would rather do it in his backyard than somewhere across the country. That's just affinity. That's just, that's the way people are.
That's true.
You want to keep it. You do want to keep it local. The first thing you do is invest locally in things you see that affect you on a personal level, etc. So we try to bake that into where possible, into our investor suitability on the way in, as well as all the AML and the KYC. We ask the question: do you prefer to invest in projects that are local to you? Do you have any industry preferences? And that way we match the client to the good he wants to do and where and how he wants to do it, where possible.
Excellent stuff. Yeah. Well, listen, they say money doesn't buy happiness, but if I'm going to cry, I'd rather cry in a Mercedes, right?
That's terrific.
But anyway, listen, Aidan, thank you so much for your time here. We're going to have to close this podcast up. We're running out of time a little bit. But before we go, if someone's listening to this and wants more information, wants to talk to you or something, or get in touch with you, what's the best way that they can do that?
Yes. So generally speaking, I can be reached in New York on 646-255-7400. If anyone out there wants to know more about the index, when it's going to be launched, how they can be kept up to date, they can send an email to CEO@CTVZ. That's Charlie Tommy Victor Zebra .fund. Once again, that's CEO@CTVZ.fund, and I'll be happy to keep it then posted as to the launch on the index.
Absolutely, and as always, we'll put this in the show notes, so if anybody's listening to this on the archive, they can just click on one of the links there. It'll take you right to what Aidan's talking about. So, hey, listen, it's always fun to break big news on a podcast, and today was great. Vicki, do you have any closing comments at all?
I think you're doing an outstanding job, Aidan. I wish you every success in your index, and we will do this again because this was an exciting podcast, quite fun and entertaining.
Thank you.
As well as informative.
I try to keep it on subject, but when you have passion, you tend to kind of orate and evangelize. But that's how you get things done.
And our listeners love it.
Well, I enjoyed it myself, and I'm glad you guys came in on the post-Thanksgiving Friday as I did to do this. We have to make sacrifices, and certainly in this case, I believe it's for the greater good.
Absolutely.
It sure is. That's great.
Thank you so much.
So everybody out there, you're listening to the Mappable USA podcast on mappableusa.com. If you just go to that website, you scroll down, you'll see all our syndication sources, which are growing every day. You know, we just added another one this week, Vicki, I forgot to tell you. But anyway, well, if you want to be a guest on the show, like Aidan was today, there's a guest tab there. You can click on that, fill out the form, and we'll see what you can do about getting you on the show. Everybody out there, thank you so much for listening. Thanks for subscribing. Thanks for your support. And we'll see you next week on another Mappable USA episode. Have a great week, everyone.